These cheap UK shares are due to update the market on recent trading in the days ahead. I'm expecting some strong set of numbers that could cause their prices to soar. Shares in DS Smith have regained a huge chunk of their value in recent months. But the FTSE 100 box builder is still trading at an 11% discount to what it was at the beginning of the year. And this provides an excellent dip buying opportunity for long-term investors. In fact, I'd buy the packaging giant before half-year results are published on Thursday, December 10th. DS Smith declared a month ago that trading has continued to improve in recent months. I'm expecting similarly positive news in the days ahead and confirmation that it's paid an interim dividend on that better performance. In particular, I'm expecting confirmation that demand from its e-commerce customers has kept ripping higher. DS Smith continues to grab market share in this arena and is benefiting from the impressive structural growth here too. It's as one reason I own shares in DS Smith myself and why I plan to hold them for years to come. Today the FTSE 100 share trades on a low price to earnings (PE) ratio of 14 times for the financial year ending April 2021. It sports a meaty 3.7% corresponding dividend yield too. I think it's a terrific buy for value investors today. FTSE 250 defense contractor Chemring Group also looks too cheap to miss in my opinion. It might not pack a chunky dividend yield for 2021. This sits at a handy if unspectacular 1.7% for the fiscal year ending October 2021. But in my opinion a forward PE ratio of 17 times fails to reflect its brilliant long-term profits outlook. I think Chemring is a particularly great buy ahead of its full-year trading update on Tuesday, December 15th. The UK share, an expert in countermeasures and a manufacturer of sensor technology, announced in early November that it expected adjusted operating profit for financial 2020 to be at the top end of current market expectations. Chemring continues to rack up the contracts with major Western militaries. And I expect it to maintain a healthy order book in the years ahead as the volatile geopolitical landscape drives global defense spending. Scientific and technology products maker SDI Group's share price has surged since the stock market crash of late February and early March. In fact, it's just soared past 100p per share for the first time ever. Yet on paper this UK share still packs terrific value. For the financial year ending April 2020 it trades on a price-to-earnings growth PEG ratio of 0.4. SDI said in late October that it had made a very good start to the current financial year. Demand for its digital imaging and sensor products is returning to normal whilst trading at its Atik Cameras and MPB Industries units are ripping higher. Sales in these divisions have been aided by their use in the fight against the COVID-19 pandemic.